Tomorrow. Joining us now is Wells Fargo Investment Institute Chief International Strategist Paul Christopher. Paul, good to have you on the program. Welcome.
Thank you, Maria.
What are your takeaways about today's current environment?
Look, if you're a long-term investor, if you're someone who's looking ahead, you have to look back and say, is the economy still solid? Can I jump up and down on it? The answer, we think, is still yes.
So you want to look for opportunities to get into this market as this market sells off then?
Well, as this market probably hasn't finished selling off, but frankly speaking, it's not unusual for the markets to have periods where they're 5 to 10% down. You could even have a correction at this point. We haven't had one in a while.
Well, we have one now. The Dow is in correction mode. It's down 10% from the highs. I guess the question is, how much more blood is there out there? How sizable a decline from top to bottom would you expect? How much more selling is there?
Yeah, that's difficult to say, but when that finally does consolidate, I think long-term investors have a very good buying opportunity upcoming. I don't think it's going to be months. It might be a few weeks.
It's Dagen Mcdowell. If I'm an individual and I call you on the phone, I want to do something. Don't tell me to do nothing with my money. What kind of portfolio changes could I make, should I make right now, in order to at least give me some sense of calm and peace in a market that you see the futures are picking up steam here?
Right. Well, I mean, you make a good point. There's no reason to put all the chips back into the market now if it still has further to fall. But there's no reason why investors couldn't take profits in bonds and begin moving them slowly into stocks, averaging in.
Yeah.
We like large cap stocks and growth.
Large cap stocks, even though the dollar has been so strong.
Yes, look, the dollar is going to take a pause, continue its pause, I should say, as we think the Fed will most likely wait until December to make its first move.
When you look at the economy into 2016, do you see it getting any better than the 2 to 2.5% GDP growth?
The economy in the second half of this year, we think, will be above 2.5% growth, much closer to 3. We could even have a surprise reading of close to 3 for the second quarter when it comes out this coming Friday.
Why?
Thursday.
What
Why?
Makes you I mean, it sounds like, I mean, the markets are telling us that, you know, the economy is not very good or it's slowing down. You really think we had a great second quarter?
No, I don't think we had a great second quarter. I think we had a better second quarter than people thought we did last month and the month before. And I think things are getting better for the third quarter, especially on the consumer side. And we're starting to see finally a pickup in business spending.
Yeah, it's interesting the point that you make, because first you said that you don't think the Federal Reserve is going to raise rates in September. You think they push it out to December. But at the same time, you're also talking about a quarter, the second quarter, that wasn't so bad. When I look at the corporate earnings story, I think it stinks. I mean, you know, I know it was better than expected, Paul. We were expecting to see corporate earnings down 4.5%, but they actually came in showing growth of 0.04%. Okay, it was better than expected, but there's no growth in corporate earnings.
That's going to change in the second half of this year. And as you said, looking into 2016, which is the important part, we think that will get even better going forward. Surprises on the upside still to come.
So the counter argument to the bullish case you're making is that we have a global economy that's been built on debt, that the Chinese borrowed too much money to build all those big mega cities, and that even the United States, even though consumers have delevered and corporate balance sheets are in good shape, government debt is at highs we haven't seen since after World War II. The worry is that we're at some crisis moment in the markets because investors are finally reckoning with all of the debt that's going to be holding back the global economy. What do you say to people who are worried about this debt problem?
That's a question we get quite frequently, and it's not really the level of debt, although that will be a headwind for the economy. It's more whether you think you can pay it off in the chunks that you have to pay it off when your obligations come due. And frankly, budget deficits have been low, interest rates are low, companies have a lot of cash. We think that the tax revenues will be adequate to pay off the debt as it comes due. And so looking forward, no, it's a headwind, but it's not a crisis.
So, Paul, I share your view of the economy. The data looks like it's getting a lot stronger. Why are the markets disconnected from that sort of GDP data and what looks like a positive economic future for the U.S.?
Well, that's a good question. I think it's probably, mostly a question of sentiment. What was the trigger here? Maybe not any one single thing, but we could certainly look back a week or two to China's devaluation. That made people really wonder whether this was some canary in the coal mine about whether growth was going to be sustainable into the second half of the year. We think that was a misread on the global economy. China had other reasons to devalue its currency, but that you could have thought of as the trigger for some profit taking and then some broader follow-on selling.
Yeah, that was the trigger.
You talk about going into big cap stocks. It seems to me they're as exposed as anyone to China. The American economy doesn't export a lot to China, but a lot of our big companies, GM, the hotels, all the manufacturers have invested a lot in that economy, and they stand to lose if it slows down. So what do you say about that? If you look at earnings reports, they've invested expecting fast growth out of China, and they're all flatlining there.
China's retail sales growth still run 10 to 11% year-over-year growth. That's fantastic growth still. Foreign direct investment in China is still increasing as it did last month. So no, it's not really a slowdown story as you would see maybe in Europe or in Japan. China's slowdown is going from 10% to 8% or from 8% to 7%. Still very good growth.
Paul, what's your favorite international market right now? Where would you put money to work?
Oh, definitely Europe. We like the prospects for growth there. Not strong growth, but from where we are right now in terms of earnings expectations, we see more big surprises on the earnings side in Europe than we do here.
All right, we will be watching Europe. Paul, good to have you on the program. Thanks so much for your insights.
Thank you.
Maria, can I quote